All right, joining us now, Joe Lavorgna is the counselor to the Treasury Secretary. Joe Lavorgna, former White House NEC chief economist, famous Wall Streeter. All right, Joe, so we had kind of an unexpectedly hot producer price index. I'm going to let you play this out, but just look to me like, first of all, it was mostly in services. It's not a trade-related thing. In fact, the PPI itself doesn't really cover trade, doesn't talk about imports the way the CPI is. That's my 2 cents. Now, you tell me, what's the view inside the Treasury and the White House?
Your 2 cents is worth a lot more, Larry. The core goods prices were up 0.4, which is a little bit faster than where it had been the prior couple of months, but certainly nothing that's out of hand. Most important, if you look at the consumer price index, and we look at goods actually since the tariffs went into effect in a meaningful way in April when the numbers just zoomed upward, goods prices in the CPI are up 0.7 annualized since April. Things like automobile prices are actually down over 2% annualized since April. Apparel is basically flat. So you're exactly correct. There's really no tariff effect anywhere in the data. And people are getting nervous about the PPI or overdoing it. We don't think this is the start of a new trend.
So, Joe, I'm just looking at my sheets. Conrad de Quatros and John Riding. Intermediate goods, which is, I guess, the closest thing you're going to get to trade. Intermediate goods, processed goods, are up 2.1% for the last 12 months. So that's nothing. And unprocessed goods, I mean, that's the actual wholesale of the whole goods story, 0.5% for the last 12 months. So we've seen these jumps before. In your judgment, does this change anything with the Federal Reserve story? The likelihood that they should be dropping rates?
No, Larry. I mean, just to add to what you just, the statistics you gave, if you look at 10-year break-even inflation, it's around 2.3, 2.4, which when you equate it to the PC deflator, which is the Fed's preferred metric, you're right at price stability. In fact, break-even inflation is no different today than where it was a month ago. So the inflation numbers look good. As Treasury Secretary Bessent has highlighted, you've got interest rates by the Fed's calculations that are way above neutral. And the bond market itself is clearly looking for lower rates. You know,
I was trying to sell that to Steve Myron last night, our prospective Fed nominee, that he should take a look at these, market-oriented Treasury CPI break-even yields. They're forward-looking, not backward-looking. And you don't have to call a lot of people who are not going to return your call. And as you say, it's just a tad over 2%, which is the Fed's target. Joe, the good news, it seems to me, though, mortgage rates slipped to their lowest level of 25, 6.58%. You'd like to see it at 6, but they are down about 40, 50 basis points. What do you make of that?
Well, that's because, Larry, the market is anticipating, being forward-looking, as you said, it's anticipating lower interest rates. And when you look at the 10-year Treasury note, the benchmark borrowing rate globally, those yields have been below the upper end of the Fed funds rate for 3 years. That is a record long period of time. And as Secretary Bessent has said, and certainly the President has alluded to it as well, rates do seem to be very high relative to the Fed's own models and metrics.
Yeah, absolutely. Well, he told me he wouldn't mind 50 basis point cut in September and 150 basis points altogether. You're right. The rates are too high regarding something called the neutral rate. Let's not get into that. But Treasury Scott was very good and very forceful, and we need new management at the Fed. Anyway, Joe Lavorgna, great to see you, my friend. Appreciate you coming on the show.
Thank you, Larry. Same here.